Imagine a world where your financial records are not merely numbers on a page, but a well-oiled machine supporting your every business decision. In today's instruction, you will learn the art and science of reconciling and preparing your business activity statements, BAS and IAS, ensuring your tax compliance and financial integrity remain uncompromised. We begin by understanding the two key pillars of financial records: accounts payable and accounts receivable. Accounts payable is the detailed record of money owed to third parties, such as banks, suppliers, or creditors. Each purchase of goods or services generates a liability that must be recorded with precision to maintain transparency and avoid errors. On the other hand, accounts receivable represents the funds that your customers or external parties owe to your business. Here, every sale that extends a line of credit or deferred payment becomes a crucial part of your asset management. Both require accurate record keeping to support seamless tax reporting and business operations. Picture this: with every transaction, an invoice is not merely a piece of paper, it's a promise and a record of trust. Prepare your invoices in line with your organizational policies and procedures. Verify each invoice against the original source documents, checking for accuracy and subtle clerical errors that may appear. Should a mistake be found, addressing it promptly safeguards your account from potential discrepancies later in the process. Once your invoices have been meticulously prepared, the next step is proper record keeping. Every document, from receipted sales vouchers to bank deposit slips, must be stored securely, either physically or digitally, with robust backup measures. Keeping your documents safe from unforeseen calamities such as data loss or even natural disasters is just as important as ensuring their accuracy. Accurate record keeping ensures that you always know how much revenue flows in and how expenses are managed. In a world of strict legislative frameworks, these records are your most valuable defense against costly penalties. Many business owners face the challenge of reconciling their financial records with external documents such as invoices, receipts, bills, and bank statements. Reconciliation is the process where you align your internal records with these external validations. This comparison ensures that the figures reported in your BAS are precise. It is through this step that you can expose any disconnections between your books and your bank's records or any missing transactions that might skew your totals. You must match every figure with its counterpart, paying special attention to ensuring that transactions conducted without GST or those categorized by specific tax codes do not fall through the cracks. Yet, reconciling your records is not merely a mechanical task. It represents a vital checkpoint within the BAS and IAS process that safeguards your business against discrepancies and ultimately regulatory penalties. It is imperative, as many authorities stress, that you get your activity statements prepared correctly the first time. When errors occur, for instance, clerical slips, transpositions, or misclassifications between GST-inclusive and GST-free categories, the cost can be steep. Rectifying these errors often involves revising prior submissions or adjusting entries in subsequent statements. In some cases, even minor missteps, such as counting a sale twice or assigning an incorrect tax classification, can have significant implications for your tax liabilities. Now, let us transition into the heart of our discussion: preparing your activity statement reports step by step. The process begins with a detailed review of all your transactions. Start by ensuring that every sale, every purchase, and every financial movement is recorded accurately in your accounting system. You then draft your activity statement, making sure to check for and correct any irregularities. It is crucial to verify all relevant categories, from the total sales captured under label G1 to the GST calculations delineated under 1A and 1B. In these forms, even slight deviations can result in errors that cascade, affecting PUIG withholding amounts and even fringe benefits tax entries. Paying attention to every line item becomes a necessity, reinforcing the principle that precision must underpin every step of your BAS journey. Within this framework, you also encounter the process of making adjustments. Unlike errors, adjustments occur when the original figures were correct at the time of filing, only to change later due to evolving circumstances. Take, for instance, transactions where deferred GST becomes applicable. If your business qualifies, any GST payment on imported goods can be deferred to align with subsequent activity statements. This dynamic aspect of financial reporting underscores the need to stay on top of legislative updates and to be ready to make timely corrections when circumstances change. As the narrative unfolds into the domain of detailed BAS and IAS requirements, consider the differences between the two forms. The business activity statement covers a broad range of tax obligations such as GST, payee installments, and various levy adjustments. Conversely, the Instalment Activity Statement, or IAS, is typically reserved for businesses not registered for GST, focusing instead on elements like PAYG and related payments. Both forms require the submission of accurate, comprehensive information, ensuring your business's obligations are met with precision. In this light, it is important to appreciate why meticulous documentation is imperative. Records must be reviewed and reconciled systematically, from checking the gross amounts in your profit and loss statements to comparing bank deposits and withdrawals with your accounting records. The reconciliation process is supported by modern accounting software that not only automates much of this work, but also builds in checks for common mistakes. These software tools, such as Xero, allow you to view graphical representations and detailed reports that make it easier to detect discrepancies. To illustrate the process further, let us delve into a practical case study involving Tech Innovations Australia, a small yet dynamic technology company in Sydney. In this example, Tech Innovations deals in various transactions ranging from consulting services and software sales to the purchase of IT equipment and software licenses. Consider the breakdown. Revenue from consulting services might total $15,000, GST inclusive, while software sales are recorded at a GST exclusive value of $10,000. The company also reports a significant sale of IT equipment. On the expense side, purchases involve items like software licenses, IT equipment, and even office furniture. From these transactions, key amounts are calculated: the total GST collected, the GST paid, and finally, the net GST payable. In the example at hand, the calculations reveal a total GST collected of approximately $2,863.64 and a total GST paid of $1,200, leading to a net GST payable of $1,663.64. Such clarity in your BAS data is what sets a compliant financial record apart from a potential regulatory nightmare. As you progress through your activity statement preparation, you encounter another hurdle: ensuring that transactions, especially those related to capital acquisitions and imports, are appropriately categorized. For example, capital acquisitions, such as office equipment or significant IT assets, fall under a distinct category that might require separate GST treatment. Similarly, imported goods demand a precise calculation where deferred GST may be engaged. It is critical to correctly calculate and record transportation insurance, customs duties, and the GST on taxable imports. These details, although minute, play a pivotal role in ensuring that the final BAS is not only accurate, but also compliant with Australian Taxation Office guidelines. Even with robust internal processes, the potential for error persists. Adjustments must be made for previous quarters, months, or even at year-end. This requires a deep understanding of legislative guidelines and a vigilant review of every financial entry. Mistakes related to clerical transcription or misclassification between GST categories must be corrected promptly. The process may involve revising previous BAS submissions and making necessary amendments in the current reporting period. It is a challenging path, but adhering to best practices can prevent a cascade of errors that might otherwise result in significant penalties. The narrative now shifts towards the procedural aspects of finalizing your BAS and IAS. After drafting and cross-checking your reports, a crucial stage ensues: the review and sign-off by an authorized person. Whether the review is carried out by a sole trader, a partner, or a designated director, the responsibility of confirming that every detail aligns with statutory requirements cannot be overstated. The authorized person must comb through the totals, validate each transaction against supporting documentation, and ensure that the data is not only accurate, but also presented in a manner that facilitates straightforward lodgement with the ATO. With the review completed, preparing your BAS and IAS for lodgement becomes the final critical step. This phase involves gathering all the necessary supporting documents, ensuring every transaction is accounted for, and submitting the activity statement within the prescribed deadlines. Timely submission is paramount, as missing a deadline can lead to penalties that jeopardize your financial standing. Whether you lodge electronically through the ATO portal or via email to your tax agent, making sure your activity statement is complete and accurate remains the cornerstone of compliance. Throughout this journey, pitfalls abound. Consider lines on your bank statement that have not been reconciled, or duplicate entries that can artificially inflate your totals. Each anomaly must be identified swiftly and rectified. Software solutions provide valuable tools for ensuring reconciliation. Import your bank statement data, verify starting balances, and ensure that every transaction matches your recorded entries. This vigilance is essential so that when the time comes to lodge your BAS, it stands as a testament to rigorous financial control and prudence. As we near the conclusion of this instructional guide, reflect on the core message. Accurate record-keeping not only supports financial stability, but also underpins your compliance with rigorous tax regulations. By diligently preparing and reconciling your activity statements, making necessary adjustments, and ensuring thorough reviews by authorized personnel, you can avert costly penalties and foster a culture of precision within your financial operations. Before we close, remember the transformative power of implementing what you have just learned. Every invoice prepared, every record reconciled, and every adjustment made speaks to the overall financial health of your business. It is a commitment to excellence that, when maintained, protects your operation from regulatory pitfalls and strengthens the foundation upon which your business thrives. Take this step-by-step guide as your roadmap. Embrace each process with diligence. Use the case study of Tech Innovations Australia as inspiration. And always view each check, each adjustment, not as a chore, but as an investment in your business's future. As you prepare your next BAS or IAS, let precision be your guiding light. Businesses are encouraged to maintain accurate and secure records, review all documentation meticulously, and consult with tax agents or advisors to ensure compliance with ATO guidelines when preparing and lodging BAS and IAS returns. Thank you for joining this in-depth guide. Let your journey toward financial precision and compliance begin now.